Welcome back to Chapter 3, Video 3. Here, we're going to continue with our adjusting entries and look at accrued revenues. Accrued revenues occur when a company provides its products or services but has not yet received its cash. So, because the company has provided these products and services in the current period, it has a right to receive payment. And an adjusting entry is necessary. So we're going to record an asset for the amount expected to be received, then recognize the revenue. This one's pretty straightforward. Here we have services of $700 that have been provided to our customers but not yet billed to our customers. So effectively we need to bill that to the customers with an adjusting entry. And here we're going to debit accounts receivable for that $700 because we expect to receive that, and credit service revenue on the income statement for $700. That's our adjusting entry. An adjusting entry would be needed for which one of the following transactions? And if you said, give you a chance to look at that, if you said answer delta, all of the above, you'd be correct. Here we're accruing some salaries. We have some services provided but not yet billed. We have some interest accrued on a loan payable. All of those are adjusting entries. All right, a key point here. Adjusting entries are needed when the cash flows or obligations occur before the revenue or expense related activity. That's a prepayment. Or when cash flows occur after the revenue or expense related activity. That's the accrual. So you will notice that in the case of adjusting entries, we never have a cash transaction. Interesting, eh? Okay, adjusting entries are unnecessary when the transactions do not involve revenue or expense activities, or if the transactions result in revenues or expenses being recorded at the same time as the cash flow. Don't need adjusting entries in those cases. So now let's post these adjusting entries and prepare the adjusted trial balance. You'll remember that when we do all our journal entries during the month, those are recorded into the general ledger, and then the unadjusted trial balance is created. Now, when we do the adjusting entries, we need to basically adjust the unadjusted trial balance to an adjusted trial balance. So here's how that looks after we've posted all these adjusting entries. We've updated them, all these accounts, for the adjusting entries. And of course we prepare that after posting the adjusting entries to the general ledger, pretty obviously. Again, our total debits have to equal our total credits. So here's Eagle Soccer Academy, and with all its adjusted trial balance accounts. You'll notice that this includes all the accounts of the company that have a balance. All right, let's take a look. Now we're ready at long last to do our financial statements. We prepare our financial statements using the adjusted trial balance. So the first one we're going to do is going to be the income statement. But here they've nicely color-coded this for us. Here are our balance sheet accounts in green. Cash, accounts receivable, supplies, and prepaids are all current assets. Equipment accumulated depreciation is a long-term asset. Then we have accounts payable, which is a short-term liability, and deferred revenue, a short-term liability, salaries payable, utilities payable, interest payable, and maybe a notes payable, maybe not as a current liability. But all our liabilities are located there. And then we have our stockholders' equity section indicated in red here. And then in blue, we have our income statement accounts, nicely positioned because the first financial statement we're going to do is the income statement. And here it is. We pick off, let me go back. Here's our revenue, $7,200. Here's all our expenses here. So all we have to do is pick those off and put them in an income statement. So our service revenues total $7,200. All our expenses total $6,000. So normally you would see tax expense in there too. We don't in this example. But here, our net income is $1,200. Now, the next financial statement we're going to do is the statement of stockholders' equity. Typically, our stock and our retained earnings. So, now, what we do is we bring over the net income for the period into the retained earnings, and we add that to the beginning balance of retained earnings. We subtract out any dividends. So if I go back here, you'll see that we had some dividends here in the stockholders' equity section. So what we do then is we subtract those dividends from our beginning retained earnings as well, and our ending balance is $1,000 of retained earnings. Plus our common stock, that all adds across to total stockholders' equity. Now, a classified balance sheet. All a classified balance sheet means is that it's been divided into pieces with some artificial totals. Those artificial totals, like total current assets or total assets or total current liabilities, those we never debit and credit. Those are just artificial totals to make reading the balance sheet easier. And we divide our assets and liabilities into its current liabilities or current assets and its long-term liabilities and long-term assets. And then our stockholders' equity we have just calculated. You'll remember that it had $1,000 of retained earnings and $25,000 of stock that we just calculated in the stockholders' equity section. We have to bring those numbers over here to the balance sheet. And if you do that all right, the assets equal liabilities plus stockholders' equity. And of course, they do here. Now, our statement of cash flows. This is the last of the financial statements, and it measures those activities that involve cash receipts, money that we've received, and cash payments, money that we've paid. Sometimes we call that disbursements. Sometimes we call it cash in and cash out, but the effect is the same, cash receipts and cash payments. And that they break that down into three sections: operating, investing, and financing. So our statement of cash flows, okay, we'll do a concept check first. And here, what financial statement would include a line for net income? And that's pretty, got to be careful with this one. If you answered Delta, Alpha, and Bravo, you'd be correct, because the income statement clearly has net income in it. But when we bring that income over to the balance sheet, it goes in the statement of retained earnings. which is part of the Stockholders Equity section. All right, the closing process. Here, I've been talking about the closing process quite a little bit up to now. Now you're going to get to see how it works. Here, we're going to transfer all the balances of our what we call our temporary accounts. And those are revenues, expenses, and dividends. We call those temporary accounts because we zero those out at the end of each period and roll those balances into the statement of retained earnings. And that prepares those temporary accounts for the next period. So we start with zero sales, we start with zero expenses and zero net income, and during the period we'll populate them again, and then zero them out, etc., etc. Okay, how do we do that? Here, we had revenues of $7,200. It has a credit balance, because you'll remember, normally we're going to debit cash or accounts receivable and credit revenue when we make a sale. So it has a credit balance. But we want to get rid of that credit balance, so we debit service revenue here, and they're going to show this all at once going to retained earnings. Sometimes we go through an account called income summary, and then it goes into retained earnings. But we'll think of it here as going right into retained earnings. And the description is we're closing revenues to retained earnings. And then here, we're going to debit, our expenses have a debit balance. So to zero them out, we're going to credit all these expenses and debit retained earnings. And we're going to do the same thing with dividends. It looks a lot like what we did with these expenses. We're going to debit retained earnings and credit dividends to roll that balance into the statement of retained earnings. So if I look at retained earnings, it had a balance of $7,200, or zero in the beginning. We've credited it up here for $7,200, and we've debited retained earnings in this T account for $6,200. That leaves us a balance in retained earnings of $1,000 after we do these closing entries. Okay. Now, here, students sometimes believe that closing entries are meant to reduce retained earnings to zero. Ooh, not true. Retained earnings is a permanent account, not a temporary account. So that represents retained earnings, that is, all the revenues, all the expenses, and all the dividends that were paid or received over the life of the company. Interesting, eh? All right. So, which account would not be closed during the closing process? And of course, that would be retained earnings, answer alpha. Only temporary accounts are closed. So now, we're going to, last step in the process, we're going to post these closing entries and prepare the post-closing trial balance. And when we do that, that's a list of all the accounts and their balances at a particular date after we've updated the account balances. We're going to go and look at this post-closing trial balance and verify that we have prepared and posted the closing entries correctly. And that means we're not going to see any temporary accounts, and they're now ready for the next period's transaction. So it looks like this. And when we return, we will finish off with video number 4, and we'll see the rest of this closing process.